Okay, in this video I'm going to talk about mutual funds. What are mutual funds? Okay, now what are mutual funds? A mutual fund is a collection of stocks or bonds. Now what does that mean? Collection of stock and bond. What happens is that most of the people want to buy invested in the stocks. People want to go and buy some stocks as a investment, whatever they are saving, and want to use that money whenever they have bad times. They make profit out of some of the money they have saved. Okay, they don't want their money to be lying in the banks, where usually in the United States where the rate of percentage may be around 1 to 2% at the most. So the only options what you have is to invest in the stock, whatever money you have. Okay, now most of the people cannot understand what stocks are, what bonds are. Okay, bonds, so far many people would be able to understand, because it is actually a government instrument which actually gives you a rate of interest, certain interest for when you keep it for a certain period of certain amount for a certain period of time. Okay, but what is the mutual funds? Actually is a alternative for a common man to invest in the stock market. What does a mutual fund do? Is actually it actually buys the different stocks from the same money you have invested in the market, and actually diversified into a different stocks and bonds, so that the risk gets diversified and it doesn't remain into the single stocks of a single company. Now suppose if you wanted to buy a stock, now if you wanted to go and buy a stock, you needed a knowledge of the stock. Whom would you like to talk to? You would go like to talk to some financial persons. These people will give you the advice. They will give you the advice at a certain percentage. They will charge you a certain percentage for the advice, and still you will not be able to be sure that whether these people have provided you the correct advice or not. Always that doubt will linger into your mind, and it will keep on going. Now, so the other alternative is actually to invest in the mutual fund. Mutual fund is rather more safe than investing in the stock, and because it is diversified into your money is diversified into different stocks and the bonds. The second thing is that because you don't know anything about the stock market, you cannot understand anything about it, so it's better to invest in a mutual fund. Third thing is because your amount is very small, what do you want to invest, you may not be able to go and buy the big blue chip company stocks where actually the profit is taking place. Okay, now each investor owns share which represents a portion of the holding in the funds. Now what has happened is that whenever these people collect for the mutual fund, people go and actually diversify into the different sectors in the different sectors of the industries, like IT sectors, metal sectors, and there are different other sectors that they will diversify this money into the shares. Okay, the shares won't be from one company, the shares would be from different companies from different sectors, and they will also diversify certain percentage into the bonds or the government bonds, because they have to create a mutual fund that is rather safe, rather just making a money. Okay, of course there are advantages of disadvantages of the mutual fund. The primary advantage of the mutual fund is the professional management of your money. Okay, because these management people, okay, they are the professionals, they are the financial professionals. Okay, they are known as mutual fund managers. They have a very good insight into the funds, and they know the knowledge of the stock market. They know what sectors are picking up, what sectors are going down, and they have a very great knowledge of the inside of the companies. They get information from the inside of the company, and most of the directors and other things, what they are going to do what is going to be their next move. And so depending upon that thing, they can make your mutual fund to be more profitable than you can expect. Okay, the other thing is this information is not relatively available to any layman. The mutual fund is relatively inexpensive way for a small investor to get the full-time manager to make and monitor investment. What it means is that it is very inexpensive, because you are buying a small investment. You want to actually buy a small investment stocks. What I mean is that you want to invest it very small in a small way, not rather in a very big way. If you want to invest in a big way, you do not require a mutual fund as such, because you are a small investor, you are, and you don't have any knowledge about stock markets, bonds. You will go to these peoples. Okay, they will give you the professional. They will actually do the work for you, and you just have to invest. That's it. They do all the work and everything. Okay, you are just actually have to invest in the mutual funds. That is their job to look into what they are going to do. Okay, by owning a shares in the mutual fund instead of owning individual stocks or bond, your risk is spread out. It's just like telling that don't put all your eggs in one basket. Okay, it's just like actually when you are diversifying into different sectors and and in the different industries, your money is getting diversified to the different sectors, different industries, and then stocks and bonds. Okay, bonds are government actually things, they are never going to fail. The government is always going to provide you with that basic rate of interest in the bonds, which would be for a certain period of time. If you buy a bond, you will be get locked in forever till the period actually gets over. But if you buy a mutual fund, you can always go and sell this mutual fund in the stock market, though it has an investment indirectly into the bonds, but you are not locked with that problem with a bond inside the, because you are in the mutual fund. Okay, large mutual fund typically owns hundreds of different stocks in many different industries. What does that mean? Is whenever there are large mutual funds, okay, when they always invest in a different stocks in different industries. That I have already told it to you, that this is something actually they do it on a regular basis. It's done by or whether it is for a small or a large industry, large mutual funds, they do it in the different companies, because mutual fund buys and sells large amount of the securities at a time. Its transaction costs are lower than what an individual would pay for the securities. But naturally, when they are buying the bulk, the processing fees and other things are comparatively lesser compared to when an individual would do it, because that will actually lower the selling and buying shares, but it will increase the transaction cost. Okay, just like an individual stock, a mutual fund allows you to request that your shares be converted into cash at any time. What it means that you can always sell your mutual fund whenever you want, feel like. Many of the mutual funds can be seen trading on the stock market. You will always be able to know the price of the mutual fund whenever you want to buy or sell. Okay, at any day, and any day, most of the stocks, if it is listed on the stock exchange, you can see the price, and you can always know about the price you are going to. It will always show you the current changes of the on the mutual funds and what each mutual fund cost that day. Creating, distribution, and running a mutual fund is expensive proposition. Okay, what happens is whenever you are actually these fund managers, whenever they are there, okay, they actually take a certain percentage from the mutual fund every time whenever they actually buy and sell this mutual fund. They are actually managing this mutual funds, and they are always going to get the cut in that percentage. Remember, there is mostly in most of the cases there won't be any salaries for this mutual fund. They are supposed to be paid in the percentage. If there is a salary, still there would be these people would be paid in the percentage. Whether the mutual funds make a profit or not, it doesn't matter. When a fund manager sells a security, a capital gain tax is triggered. Now what happens is whenever this fund manager actually sells the security, whatever that thing is, that shares, of course not the bonds, the shares. Okay, what happens is that every time they are making a profit, their capital gain tax is triggered. If they are doing on a frequent basis, the more capital gain tax the company is paying, the mutual fund is paying. And what happens is that the lesser the profit for you. Remember that thing. If the more capital gain tax is triggered every time, there would be lesser profit for you if you are investing in a mutual fund. That is about where the disadvantage come. And the other disadvantage is that is the mutual fund financial managers, whatever they are going to charge you with a high rate of the percentage, whether the mutual fund is going to make a profit or loss. Okay, this is where I will end, and I will take up the other mutual fund part in the next video.